Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
It is Samantha. So as I mentioned, I'm a little under the weather and the throat's a little sore, but I hope that you can hear me enough so that I can show you some charts this morning. All right, we had, as you know, an eventful day yesterday and no rest for the weary. I did not take a break at all. So I did update a lot of my analysis in this post that I sent out after the FOMC announcement where the market started to sell off. Luckily, I had been showing this since December 2nd, and I even warned yesterday it wasn't done, plus my intermarket. So this was a recent post that I put in that literally was entitled Melt Up into Instability. And if you look at these charts, you'll also see where I've got concerns about the next charts that I'm going to update you on, and that is breadth and selling under the surface. Now, the reason for the trigger, of course, was a hawkish cut. Fed priced out basically all these aggressive rate cuts that had been priced in. And that created by also him focusing on inflation, because nothing else has changed since his Jackson Hole speech back in August, 3+ months ago, talked about how Powell still wants to get inflation rates lower, which is not realistic. Nominal rates rose, right, when they said they weren't going to cut 4 times next year, but only 2. And immediately financial conditions tightened. So investors, they, by the way, they picked a hell of a day to announce that at the Fed because it was the largest options expiration ever coming in on Friday with a 10-to-1 call skew, which means there were 10 calls for every 1 put. And a lot of that stuff was sold puts. So once it started to sell off and it picked up that 2%, and when I had been typing this in, we hadn't hit the negative 2% in SPY. And that was my last thing before I got this thing actually out. I said, for now, remember one thing. SPX drawdown of negative 2% will set free a VIX move that many don't expect. The result was yesterday, VIX exploded 74%. But the bigger issue is it's the second biggest one-day percentage increase in history. It was a big deal. This is not yet get out of the pool conditions because we still have, big picture, higher levels in the Qs and in semis to hit. Repeat, this is not get out of the pool, but I'm telling you, this sell-off is not done right now. So the short-term sell-off, of which we've only had 5%, is not done. But bigger picture, I do not see NVIDIA and the NASDAQ and semis done going up. So understand your time frame. Chase, swing, trend, very different. Few days for chase, few weeks for swing, few months to years for trend. Anyway, the point is, all of this is very much contingent on what happens with this yield curve, and it's moving higher. And I warned when I posted this last week, this is the most important thing I'm watching right now from a macro standpoint. Higher dollar is a wrecking ball. Higher yields is a wrecking ball. There are key levels. I gave you the key levels. We're pushing above those key levels. So you had a perfect storm, really. In many accounts, you had a perfect storm of yields, dollar yen, dollar loonie, etc., etc. And this options, which is so offsides with 10 calls for every 1 put. And then, of course, you get the result of all this bad breadth hitting. And I've mentioned in lieu of sector rotation, there will be volatility. That's exactly what happened yesterday. And for good reason, I posted in my trading room notes the day before yesterday, this exact word for word. So read those bloody things. Did they smell a yield spike now? Continued breadth breakdown and net selling under the surface. And then I literally warned over the past 2 days, crashes occur from oversold, not overbought territory. In the trading room, I said, everyone's buying this dip into the FOMC, expecting small caps to bounce. I don't. I expect a trounce. Gave you levels on Monday, Tuesday, and these were the levels. And they were taken out. So the small cap IWM, 230 with a price target, we hit that. That was easy. Below that is 224.23. Guess how close? We came through it. And guess how close we came to the diamond short overshoot, 422. Most of that happened yesterday because the negative 2% in the SPY drawdown triggered. on that financial tightening from the macro conditions and everything else, because there was no support underneath. Value had been crushed. Tech was on its way to softening. SPY was risk of drowning. I showed you that funny meme, but I also wrote, based on what I'm seeing from my volatility ratio, from my dollar yen yield differential, they're all bearish. This reversed lower. Remember, I showed you this December 4th, and now Q and SPY are looking as a catch down trade. Well, they did. As I went through and I spent hours going through my intermarket analysis. Hans had a great VIX position. I had offered two, and yesterday we had a massive VIX surge. This is really an important, I think, message that we had a very large amount of selling, 1.5 trillion in market cap. That's a big deal. That's how the market's going to work now. Convexity is going to work both ways. This yield curve is still moving higher. It's still a threat. Big picture, that's not done. This puppy, wow, this is what happened with that. Remember I said, and I had posted the chart, the before and the after, and I had shown you this head and shoulders. And I said, all we have to do is trigger the 1.2 and the market will be pulled down. Well, it was pulled down. It was pulled down to the August 5th low. Not quite, but almost, right? Not perfect. And I think it needs to bounce around here before it can get supported and move higher. This is what happened. Also, I warned the dollar yield ratio. We get above 300, it's risk off. Remember that? I show you these every single day. This was the head and shoulders on a diagonal. Doesn't matter. We reversed 1 month of gains all the way back to November 18th, 19th. So that's a trigger. Warned about it. That's a trigger. Warned about it. This is the move that we had. Boom. Liquidity came out of the system. This is what happened with the dollar above that 107.5, above 108. That's the wrecking ball. This is what happened with yields. Remember, I said, be careful. We're going to get back above that 4.37. I literally wrote big, big, big letters. Be careful of this yield spike. And we had the yield spike and it's still going. So everything changed when this started moving higher. And I warned about that and I wrote about that in my market thoughts. Big picture, you know how I feel about next year. You also know that I still see higher in NASDAQ, semis, and NVIDIA, but not right now. Right now we have a correction and it came in early and announced early by showing us the selling was under the surface starting when? Right here, December 2nd. Growth took off and value crashed. And it was the biggest spread in history, by the way. So it wasn't a little bit, it was a lot. So here's your dollar poking up above the 108. Oil is doing nothing, but I can warn you that as the dollar keeps going higher, global demand for oil will start to fall. But for right now, here's your bond. We hit the first price target, the second price target, and we're almost at the third price target. Maybe we can consolidate here and have a little move higher. But this is what it looks like now. Next day. That's the yield curve, 10 and 2 year. And then we've got the MAG 7. Look at that. It hasn't even put in a reversal pattern yet. This is on a weekly. Still pushing higher. This is still the safety. Value gets crushed. Tech gets jammed. And everybody is holding out in the big balance sheet performers. Look at dollar yen. It went through my 155. Remember I gave it a price target? When this turned, I said, oh, we got a nice Morningstar reversal. It's pushing higher into the 155 right up here, 155, 156 area. We're above it. So at some point, that's going to turn solidly lower, and then we're going to have a yen carry trade unwind. But that's next month, I expected. For right now, look at this differential as well. Look at this, boom. Remember, I had warned, and this started on the 4th, even though the value rotation started on the 2nd. It started coming over, and I said, this is the correct answer. This yield differential between US and Japan, 30 and 30. This is correct. This was SPY until this. This was Q's, where they were holding out in safety. And this is inverse VIX. It's actually SVXY, and I want to show you SVXY. Gold tanked on higher dollar. Silver, metals, mining. I also posted a detailed thought on credit spreads, of all things, yesterday. So I did 3 or 4 posts yesterday. This is moving higher. This is big picture, very bearish. But it's all about time frames. That's not a today thing. That's not a today worry. But this is where we could go sideways for a while before they come in and do some kind of intervention. Maybe they don't want to do any intervention. You know, the market actually started rolling over the minute Trump rang the bell on the New York Stock Exchange. Remember how I had posted this in intermarket analysis, and it was up here, and I put a square box. I said, this is what I'm looking for. Look where we just tagged. I actually put a yellow box, but anyway, it literally just came down to that trend line. Look at how it's also still rolling over. So it needs to base and then turn higher. That's the game that we're playing, is unless we get some kind of macro intervention, and I don't see it, I think this has to base. Same thing here. My SPX, RSI, and Bollinger Band, all that jazz. When we fell in April, we triggered higher in May. We fell in August, we triggered higher, we stayed above. Same thing in November before the election. We need to actually base here, turn, and then move higher and get above this 50 level. So give it a little bit of time. That's all. So it depends on your time frame, of course, but I'm kind of showing the different views of stuff that starts to break down, usually has to base and then turn higher. So let me show you what I mean in my indicators that are very, very, very helpful, that help me spot this early, right? So here was cumulative selling. It came in, I noticed it Monday at 11 a.m. and I warned up. We're getting extended. We're going to come back to this channel. We break inside of this channel. This is what we have today. A little bit of a bump. Now, what do we have down here? Because this is when it crossed over Monday, the 2nd. This is when it broke down, basically the 4th and 5th, all that week, first week of December. And I said, it's not done selling. In fact, now that small caps have rolled over, it's time for SPY and SPX to come on in. This is where we are. We're in oversold. Oversold means we can stay in oversold. Qs had a massive breakdown through the 21-day, but they have not even come back down to the 10-week yet. But that's a bearish engulfing on a weekly. So even after this bounce, it's going to set up for a nice short. That's how this probability works anyway. The probability would be that it heads down to the 10-week. SPY, that was a dump. It broke through the 21 all the way through levels I had, including the 55, including the Keltner. And that's why it's having a reflexive bounce. Look at that Keltner, that Bollinger Band, very extended. I think they said it was a 6 standard deviation move for the straddle on a Fed day. It's never happened like that before. Anyway, it bounced right into resistance, which is this 592.65. Look where it got defended. Perfect. Like, look at this, 286.12, and it hit basically 586 and bounced into the 10. But that's still a very nice reversal candle. So it wouldn't surprise me if it bounces into this area, but then we'll see. So we've got some distribution in the market. It came slowly and then suddenly. Both of these were outsized. And so, of course, we're having bounces on the 21-day because that's the most extended, off the 55-day. And here's small caps. Second, and then nope, I still don't trust it. 230 was baseline bet, and then I updated and I gave this level, 224.23. It blew through the 100-day. It blew through the Bollinger Band. Extremely big move. That's oversold. Does that mean it's a buy? No, it can stay here for a while. And in fact, I would not be surprised now that it's come down. It's come all the way through the 10-week to the 21-week, and it has a relationship. It's trying anyway with this 221.65. It's pretty impressive. I wouldn't be surprised if it heads back down after this bounce. And diamonds also came down. They almost came to my price target. So this was literally what I gave you a few days ago, 422.62. So this is still the price target. So you can see where it bounced off the 100 and it's oversold. You can see where it blew through the 100. Anyway, I just wanted to show some of those charts. And now SVXY, this was amazing to me. Still amazing to me. This is August 5th. It broke this entirety of this market. And you can see where I also said Monday, Tuesday, careful, this thing is breaking. This is inverse VIX, long story short. This was price target 48.64, so we overshot and came back in. But in all of these cases, look how the Bollinger Band is opening up. In all of the cases, even down here, it's just starting to open up. Qs, nope, not yet. They're not even, they don't even care. IWM, look at that Bollinger Band starting to open up to the downside. Diamonds, that's what it needed, to open it up to the downside. So SVXY, do you know what I still say we have volatility? Is because this pink, magenta, 100-week. Look how it tagged, and got defended, tagged, got defended. I would be very surprised if it didn't come back down here to 47. So we have a reflexive bounce, but also kind of take note how this is rolled over, but hasn't stopped going down. So you usually kind of go here and then move higher. See this little arch over here? It's not strong, it's not weak, it's in neutral territory, but it shows me that it's more likely to roll over again. And again, we have debt ceiling on Friday, which is likely going to have a looming shutdown. So enjoy the bounce while it lasts. Maybe we have a little bit more volatility, so this comes back down to the 100. This would be a better place, I think, to get supported. The 230 puts on the small caps that obviously started weakening here, but really, this was the level it needed to break in order to fill this gap. It went right through it. And then it had an itty bitty pathetic bounce into the 3 and then softened. And then, of course, the market gapped down this morning, but it's trying to come back up. So if you took those, obviously, it went from $1 to $10, and they're starting to fall now because the market is trying to digest post options expiration soon, right? Today is the day. SPY went ex-dividend, I think $1.75 or something. You've got quad witching. So you got a lot of stuff at the market open that's going to be funky. But the point I wanted to make was this was a fabulous run down into this 21 week. You can see gaps everywhere, right? Everywhere. So in small cap land, we've made it back into this support level, which is that it's the 30 week. And this could stay here a little while versus just continue to fall out of bed. I can see some green shoots, and I don't mean this particular day, although that's what's happening. You can see it pre-market, right? Went all the way back down to 1665. Markets obviously careened lower. Asia didn't like our sell-off the past few days. Chinese yields dropped another, oh goodness, I think 17 basis points, which is, in percentage terms, they have hit great financial crisis lows when it comes to their one-year bond yield, and it fell another 1% last night. So we have some scaredy central banks right now that are trying to ease as the U.S. yield and dollar has been very firm. But this is obviously a green shoot in this rollover, but we still have a 200-day. So if you have a little bit more patience or maybe a flyer into the next year end, it wouldn't surprise me if we go and tag this 200-day. Okay, but a lot of that is going to be obviously we're bouncing, right? You can see right now we got a little bit of strength here, but obviously this is something that rolled out of bed. We had the melt up going on with bag 7, and we had the decay underneath the surface in net selling and in breadth destruction. And finally, SPX and QQQ caught down as expected. And right now, there's not a lot here that says, ooh, I'm comfortable, right? Look at this. This is a mess. This is an absolute mess. Trying to find a little bit of support at 506 is not a comfortable place still, where we have either an event to move higher like the election, or we're just going to have to basically suck it up and expect this chop and indigestion, because that's exactly what happened. This is important, and this is why I posted this in Trading Room Notes yesterday. So once this started to look like it was going to come on over, and I warned SPY and Qs are now going to catch down with IWM and diamonds, right? So this was literally Monday, Tuesday. Okay, careful. Boom. And it broke open the Bollinger Band, right? And then we had day 2 of volatility. And all we're doing right now is trying to get down here and base so we can have a proper bounce. 58.50 is a critical level. As I put here, this is negative dealer gamma. So we get selling begets selling kind of deal if we trigger that. So just kind of keep that in mind. I didn't trust that gap up. I told you yesterday, I still don't see the selling done. I still don't today. I see it. It should be done. It should be done, but we have no signs of it confirming. So that's very different. Yesterday, I didn't see it done. I don't trust it, my exact words. Today, I'm seeing green shoots.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.